Consolidated amounts when an affiliate's debt is acquired from a non-affiliate. Assume that a parent company owns 100% of its subsidiary. On January 1st, 2019, the parent company had $600,000 of bonds payable par outstanding at a carrying value of $630,000. The bonds were originally issued to an unaffiliated company. On that same date, the subsidiary acquired the bonds for $594,000. During 2019, the parent company reported $270,000 of pre-consolidated income from its own operations, i.e., prior to any equity method adjustment by the parent company, and after recording interest expense. The subsidiary reported $150,000 of pre-consolidated income from its own operations after recording interest income. Related to the bonds during 2019, the parent reported interest expense of $67,500, while the subsidiary reported interest income of $61,500. Determine the following amounts that will appear in the 2019 consolidated income statement. And then we have A, interest income from bond investment. And so that's going to be 0. The consolidated financial statements will never include any interest income from a bond investment in an affiliated company. B, interest expense on the bond payable. This is also going to be 0. The amount's 0 because the bond was constructively retired on the first day of the fiscal year. If instead the intercompany bond transaction occurred on the last day of the year, then all of the interest expense would have appeared on the consolidated financial statements. And if it were any other day during the year, then it would be the proportionate share of interest recognized. Then we have the gain or loss on the constructive retirement of the bond payable. And so we can take our $630,000 minus the $594,000 for a $36,000 gain. And then for the consolidated net income, let's use some space down here. So we'll have the parent's net income, the parent's percent of the subsidiary's net income, and then we'll back out 100% interest expense, which we're adding back, and then 100% interest income, which we need to deduct, and then we add in the 100% constructive gain, and that'll give us consolidated net income. So now that we have that laid out, we can plug in the information. So we have the parent's net income of $270, and we own 100% of the subsidiary, so we'll list the entire $150,000. Then the interest expense was listed for $67,500. The interest income that we're going to deduct, so I'm going to put as a negative $61,500. Our constructive gain of $36,000 calculated in Part C, and then we can do a sum for total consolidated income equal to $462,000.